The future of real estate has some really big problems, and important data that was just released shows us exactly where the next crash is going to be. So in this video, I'm going to show you which areas you need to be careful in, why it's happening, and what you should do about it if you're in one of these affected areas. So stay tuned. All right, welcome back. If you're new to the channel, my name is Mark Moss. I like to talk about making money, investing money, having just overall success. If you like any of those topics, which I'm sure you do, please go ahead and hit the like button. It helps more people find these videos. Click the subscribe button, hit the bell notification if you haven't done so already. Now, I am diving into real estate again. I recently did a video about real estate. I'm gonna put a link to it right up here. And I got lots of questions, lots of comments. I've been in the real estate, all areas of real estate for well over 20 years, so quite a bit of experience there. And so everybody's asking questions, so I thought, let me put a little bit more specifics out there. So I'm gonna tell you exactly what's happening with the data and what areas that we expect that to happen. So we'll just dive a little bit deeper, show you the areas that are gonna be hit the hardest. Now, understanding the markets, and I don't care if it's real estate markets or cryptocurrency markets or stock markets, they all work very similar. And the number one thing you need to understand is that, to make it simple to understand it, is that markets stop going up when there's no more buyers. That's it. It's super, super simple. If nobody's buying, the prices aren't going to go up, right? Supply and demand. So when there's no demand, it doesn't matter, right? The price goes down. So with real estate, just ask yourself, will there be more buyers? Why do people buy? Well, for the last, 20, 30, 40 years, we've seen interest rates go down, 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 made homes more affordable. Interest rates are basically at zero. So will interest rates keep going down and continue to push more buyers? Probably not very much anyway, right? Will wages start rising? Well, we haven't seen real wages go up since the 70s, so probably not. Will the CV, the virus thing that we're dealing with, how is that going to affect it? Are there going to be a lot of buyers right now from that? Probably not. So we have to think about those things. But like I said, there's new data that just came out. And there's two pieces of data that I'm going to look at specifically that are going to give us some really good insight. They show us what's going to happen, and I'm projecting a slowdown, show us what sector that is. So like I said, the first thing you have to remember is markets stop going up when there's no more buyers. And so we're already seeing less and less and less buyers. Of course, right now, people are out of work, they're not making any money. But overall, and it's not just right now, over the last couple months, we've already seen this because of tightening lending guidelines. All right, so that means when people can't get loans, or when they make it very hard for people to get loans, less people get loans. And when less people get loans, less people buy houses. Simple, right? Just this week, we saw JP Morgan Chase, one of the largest banks in the United States. They announced that moving forward, at least for now, they're only going to be doing mortgages for people that have a 700 FICO score or better and have a minimum of 20% down. Now, we can argue if this is good or this is bad, but we do know that it's going to cut out a lot of buyers. So a lot of buyers maybe don't have 20% down. Maybe they have 10% down. A lot of people don't have 700 FICOs. Maybe they have 680, 650. They're still good borrowers. And in most times, they would have no problem getting loans. However, now 700 FICO, 20% minimum down. So is it good? Maybe it's good in the long run. We'll have better buyers. But in the short run, we're going to have a lot less buyers. And of course, no more buyers, markets start going down. The other piece of data that we're looking at is what's called the Mortgage Credit Availability Index, the MCAI. You can see it up on the screen right now. And it tracks various aspects of lending standards with an overall index. And then there's like several sub-indexes and different types of mortgages that we can look at. But as you can see from the chart on the screen right now, when the MCAI rises, it means lending standards are loosened. It means there's more credit, more mortgage credit available. And if there's more mortgage credit available, there's more buyers, right? Prices go up. But however, when this falls, the MCAI falls, it means that lending standards have tightened. It means there's less mortgage credit availability. And when there's less mortgages available, there's less buyers. Markets go down, right? This chart up on the screen right here is what's called the conforming MCAI. All right, now conforming is basically loans that fit into a particular guideline. So this covers mortgages that conform to the loan limits of maximum of 510 in some counties, up to 765,000 in other counties. So that's one. They can also, these types of loans can be packaged up and sold off to Fannie Mae, Freddie Mac. You may have heard of those. Those are government agencies. And this index, when we're looking at this, we can see it's barely dipped about 2.7% from February to March, but we can also see over a longer period of time that it's already been declining down. All right, so we can see it's already been heading down well before this CV virus that we're dealing with right now. Now, non-conforming, or we call them non-QM loans, those are basically borrowers with low credit scores, right? Like JPM said, below 700. So borrowers with lower credit scores. These are mortgages with higher loan to values, LTV ratios, or less down payments. These are also jumbo mortgages. So that's loan balances over 510,000 in most markets. In the most expensive mortgage markets, jumbo mortgages are over 765,000. Also, they're LIBOR indexed adjustable rate mortgages. These are ARMs. They are super, super popular. They help people get in for lower right now because the interest rate's adjustable. And we've seen, like I said, Fannie Mae, Freddie Mac, they announced that they would be halting the purchase of all these loans. So all these non-QM loans, non-qualified mortgages, that lower credit scores, less down payments, jumbo mortgages, adjustable rate mortgages, they're all out. They're all off the table. The reason why is because the markets are pretty dangerous right now. And when a lender uses these QM guidelines and does mortgage loans per these QM guidelines, then they receive legal protection. They can also really easily sell these QM mortgages on the back end. They can sell them to Fannie Mae, Freddie Mac, other government entities, etc. But the non-QM loans, they're super difficult. The lenders get stuck with them. They carry a lot of risk. And so that's why lenders don't want them. That's why JPM is saying we don't want them, and they're becoming just super careful with them. We can see how bad this is by looking at a few indexes. The one up on the chart right now is the government MCAI. And this tracks mortgages that are backed or insured by government agencies, so the FHA, the VA, USDA, etc. So these already fell by 6.6% from February to March. All right, this also shows us the process of tightening lending standards have already happened. It's already been going on. You can see from this chart, it's been going on for about 2 years now. All right, but where we have the biggest problem, and this is where I expect to see the biggest problem in the real estate market, this is where prices are going to start falling apart first, is going to happen in the jumbo MCAI. You can see it on the screen right now. So the jumbo loans, as we've already talked about, they cover mortgages exceeding $510 in some markets, but in the more expensive markets up to $765,600. Depends on the county. All right. These loans, these jumbo loans can't be sold to these government-sponsored entities, the Fannie Mae's, the Freddie Macs. The lenders have to deal with these on their own, and we can see that they're dropping super fast. As a matter of fact, they've dropped almost 40% in just the last couple of months. So they've basically fallen off the map. So there's no loans available for homes over $765,000. Gone. Like JPM doesn't want to do loans. These don't want to do loans. They're gone. So the loss, the lack of availability to get these jumbo loans, it's not a big problem if you're in markets that don't have expensive homes. If you're in the Midwest where there's $200,000, $300,000, $400,000 homes, no big deal. But in the most expensive markets, like on the West Coast, I'm in California, all of California, Pacific Northwest, Washington, Oregon, a lot of parts of the East Coast, New York, Boston, Massachusetts, Washington, D.C., etc. All those areas, they're well over $765,000. And so it's basically going to be impossible to get financing on those loans. All right. Now, you guessed it, if you can't get loans on those, it's going to be very, very difficult to buy those homes. And if it's difficult to buy those homes, sellers are going to have a hard time selling those homes. And when sellers have a hard time selling their homes, what do? They lower the prices. All right. When no more buyers, markets stop going up. And if no one can get loans, no one's buying them. All right. So watch out for the areas that have homes over $765,000. That's what you need to be doing. Now, I get a lot of questions. Should I sell my home now? Should I hold on to my home? Should I buy a home? Well, if you were thinking of selling before the whole CV virus happened, all that, if you're already thinking about it, then yeah, you probably should sell. Now is probably a good time. If you weren't thinking about it, I wouldn't let this be a decision to push you over the edge to sell it. If it's your home and you're planning on just living there, who cares if the value drops, right? It's your home. You live there. But if you're thinking of more of like an investor, you might want to be moving soon, you're already thinking about selling, now might be a good time to do that. Now, if you were thinking about buying a home, especially if that home is in that more expensive range that's going to be affected first, it's probably a good idea to wait. It's probably a good idea just to wait on that. Warren Buffett's partner, Charlie Munger, says the big money's not made in the buying and selling. The big money's made in the waiting. So if it takes you a year or two, but you save 20 or 30%, wouldn't that be worth it? I think it would. Like I said, especially in those homes that are over the $765,000. So I expect to see that area of the market start cracking up pretty quickly. We've already seen the mortgages have dropped off almost 40%. So we're going to start to see that softening happening really quickly. And then most likely it's going to start to spread to the rest of the industry. It's going to be interesting to watch how that unfolds. Of course, we don't know what the government's going to do. The Fed, they're the wild card in all this. They could just come out, start printing money. They could change the lending guidelines. They could start buying houses directly. We don't know. But what we do know is the data that just shows us that jumbo mortgages are off the table. It's going to be very difficult for anyone to buy a home over 765. So be careful. Let me know what you think. Leave me a comment down below. Do you agree with this? Are you thinking about buying or selling a home? Let me know. I'd love to hear your opinion on that. Give me a thumbs up on the video if you like it. And if you don't like it, give me a thumbs down. Either way, I always want to hear your opinion. And that's it. To your success. I'm out.